So this question is called Kesare. It is a past paper in respect of P2 from a few years ago. Not the most popular topic, deferred tax, but if it does come up, it could also be integrated with a number of other standards as well, testing us. Do we know the accounting treatment and do we know the deferred tax consequences? So therefore we need to know our accounting in order to be able to deal with it. I always start off with any exam question by going to the requirements, and although we're given the balance sheet of this company, the first thing that it asks us is to discuss the conceptual approach. So that's what I'm going to do. So it says, discuss the conceptual approach for the recognition of deferred tax using the temporary difference as far as deferred tax is concerned. We'll be talking about concepts. Start off with the basics. If you're short of ideas, the framework is a great place to start off with. Per the framework, financial statements are produced to give information to key user groups, especially investors and lenders. The decisions they make might be influenced by the taxation payments made by companies. Because if a company's got a very large tax liability, you might decide that you don't want to invest in it, you don't want to take it over, you don't want to get involved. The temporary difference approach for deferred tax applies the accruals principle to the business in terms of its tax commitments. So each sentence, separate idea, separate point, hopefully a separate mark. The tax authorities themselves in many countries, however, ignore the accruals approach and calculate tax on a cash basis. Per the framework, information in the financial statements should be relevant by highlighting the potential future payments of tax in the form of deferred tax. We are showing relevant information to investors. Some people do not like the temporary difference approach. This is because deferred tax liabilities in the statement of financial position may not satisfy the definition of a liability per IFRS. This is because a liability is an obligation resulting from a past event, the tax payable on a temporary difference is more likely to arise on a future issue. Because some deferred tax liabilities will actually never be paid, because we'll never actually satisfy, we'll never actually trigger the tax rules. So some people say that the liabilities and the assets shown in respect of deferred tax in the financial statements overstate both assets and liabilities, but they overstate liabilities to a greater extent. So that would be part A. I've got 6 broken down areas there. I'm hoping I'm going to pick up 6 or 7 marks. Part B says calculate the deferred tax liability. So what are we shown here? Well, we are given the statement of financial position of Kesare, and then you've got further information. So the way that I would approach this in the exam, I would literally get out my pen and I'd say, well, the first thing that we see here are financial assets, reference note 1 to financial assets. We've then got information on borrowings and so on. So I'm going to deal with this on an item by item basis. I'm not going to calculate the total liability. I know it's what the examiner has asked us for, but the marks are going to be given on an item by item basis. If at the end of the question we have enough time, then we would calculate the total. But it would be the least of my worries. So the first thing that I've got in terms of the additional information is financial assets. We calculate deferred tax by comparing the carrying amount of an asset in the SFP to its tax base as determined by the tax authorities. So I can create perhaps a little table here. That's what I'll probably do that. So what do we have in respect of our financial assets? we are showing them at a figure of 9,000. But let's read the note. It says the financial assets are classified as investments in equity instruments, but they're shown at cost. The market value of the assets is 10.5 million. Per IFRS, we should restate the figure for the financial assets to fair value at the SFP date. This will result in an increase from 9 million to 10.5 million. It says, as allowed by IFRS 9, an irrevocable election was made to changes in fair value to go through OCI. So companies usually take gains in financial assets to the statement of profit and loss, but they are allowed, as appears here, to make an election to show the gain in OCI. So therefore we're going to go debit financial asset 1.5 million, credit OCI 1.5 million. The carrying amount of the asset now in the balance sheet, having put through the adjustment, is 10.5 million. What is the tax base? The tax base is the value of the asset for tax purposes. Now, as far as the tax authorities are concerned, we purchased the asset for $9 million. And it's still worth $9 million. So therefore, we have a taxable temporary difference of 1.5 million. It says in note 6 that we would assume that taxation is payable at 30%. So in respect of this particular item, let's get rid of this row. So deferred tax at 30% is 450,000. So what we would do here is that we would debit OCI 450,000 and credit a deferred tax liability. It is necessary to apply the matching principle and show the deferred tax expense in OCI to match against the gain that appears there too. So I'm showing the gain in OCI, I show the tax on the gain in OCI. If I show the gain in statement of profit and loss, I show the tax on the gain in profit and loss. And that's logical, isn't it? If I'm going to show a profit somewhere, I ought to show the tax on that profit too. Next, it says the stated interest for the long-term borrowing. So let's go down. We go down to our non-current liabilities, and we've got long-term borrowings of 10 million. The stated interest is 8%. The loan represents a convertible bond which has a liability component of 9.6 million and an equity component of 0.4 million. The bond was issued on the 30th of June X6. So notice these accounts are prepared on the 30th of June X6. So we don't have to worry about interest. Per IFRS, the bond should be separated into its component parts of debt or liability and equity. If we do this, then we will have a carrying amount for the liability, and the carrying amount is 9.6 million. The tax base, well, the tax base hasn't changed. As far as the tax authorities are concerned, is that we've borrowed 10 million. They don't believe in any of this accounting nonsense. So we've got 10 million. So this gives us a temporary difference of 400,000. Now this is the tricky bit. If you have an asset and the tax base is larger, you would normally say that you have a deductible temporary difference. But because this is a liability, it's the other side. So this is a temporary taxable difference because the tax base of the liability is larger. We therefore have deferred tax of 30% times 400k equals 120,000, and here we would debit statement of profit and loss 120,000 and credit our deferred tax liability 120,000. Next, we've got our pension and we've got past service costs. So what the examiner is doing here is the examiner is testing us on two things. Do we know the accounting treatment and do we know the deferred tax consequences? So here we have the past service costs. per IFRS, past service costs should be recognised immediately. So this would be debit statement of profit and loss, 520k, and credit pension liability, 520k. The tax base for this would be 0, as it makes no difference to the tax authorities. I'm not going to do the deferred tax calculation here because I've taken a look at the statement of financial position and I've seen that we have an employee benefit liability already in the account. So all I'm going to do is I'm going to adjust there. So if we take a look at other assets and liabilities, and here perhaps it would be useful to have a table so we've got the item, the carrying amount, and the tax base. Because if I take a look at note 4, we've got all these other assets and liabilities. So we've got PPE. The tax base of PPE is 10,000. I know we should call it property, plant and equipment, but for the sake of the exam, you're not going to lose marks for calling it PPE. No marker, no examiner is going to sit there and go, oh, PPE. I've got no idea what that means. What could the student possibly be talking about? You know, so whilst we strictly should say property, plant and equipment, don't worry about it in the exam. Yeah. We're told that the tax base is 2,400. Next, we've got trade receivables. And our trade receivables have a a carrying amount of 7 million. But we're told in the question that the tax base is 7,500. We've got other receivables. Carrying amount 4,600. Tax base 5,000. And then we have the employee benefits. Got the employee benefits liability. Now, according to our statement of financial position, it was 4,000, but remember, we've just increased that by 520 by recognising the past service costs. So our employee benefits liability is 5,200, and from a tax-based point of view, we've got a liability of 5,000. Oh, 4, yeah. I can't add up. So we work that out as a total. We've got a carrying amount of assets of 17,080 and a carrying amount in terms of the tax base of 9,900. We compare the two figures, 17,080 less 9,900, and this gives a taxable temporary difference of 7.18 million. The tax on this figure is 30% times 7.18, which gives us a figure of 2.154 as our deferred tax liability. This sum is also charged to the statement of profit and loss as an expense. So that's note 4, part 1. It says other intangible assets were development costs which were allowed for tax purposes when the cost was incurred in 20x5. So here we look at intangibles. The carrying amount is 5,000. The tax base is 0 because the tax authorities are not carrying anything forwards. We've incurred an expense of 5 million, we've been allowed an expense of 5 million, so nothing is being carried forwards. Therefore, we have a taxable temporary difference of 5 million. Multiply that by 30%, and that gives us a deferred tax liability of 1.5 million. So debit the statement of profit and loss, because where do you show your amortization of intangible assets? You show that in profit or loss. So I'm going to debit the statement of profit and loss 1.5 million and credit the deferred tax liability 1.5 million. Trade and other payables include an accrual for compensation to be paid to employees. This amounts to 1 million and is allowed for tax when paid. So clearly we've not yet paid it because it's an accrual. So accrued employee compensation . So we have a liability in the SFP, and that liability is 1 million. Tax base is 0, because the tax authorities have said, well, we're not allowing it because you've not paid anything. Paid in 0, allowed 0, carry forward 0. So this is a deductible temporary difference of 1,000. Why is it deductible? Because for assets, if the carrying amount is larger than the tax base, you've got a taxable difference. If it's liability, it's the opposite. The deferred tax is therefore 30% times 1 million. It's 300 deferred tax asset. So we debit a deferred tax asset, 300, and credit the statement of profit and loss, 300. Why the profit and loss? Well, what are we talking about here? Employee compensation. This is what employee bonuses. Where do you show staff costs? You show staff costs in the statement of profit and loss. If the staff costs go to the statement of profit and loss, the tax on the bonuses go to statement of profit and loss. Goodwill. This is not allowed for tax purposes. Therefore, goodwill represents a permanent difference and no deferred tax arises. Okay, so that's it. And what you could then do is, if you wanted to, and I personally wouldn't bother in the exam, but you could then do a summary. If we look at the total for the above items, it gives an overall deferred tax liability of so we'd have to go back and we find for our financial assets, it was 450. For our bond, it was 120. For our other assets, 2154. Intangibles, 1500. And payables, 300. That gives a grand total of 3924. Oh, right, okay, yeah, missed that one off. Oh, that is employees, 300. So we have an overall deferred tax liability of 3924. If we take a look at our statement of financial position in the SFP, there is an existing deferred tax liability of 3,600. The DT liability is therefore increased in the year by 3,924 less 3,600. So it's increased by 324. So our double entry, I would stress to you here that I'm really be very relaxed about this, is going to be credit deferred tax liability 324. Has any of that gone to OCI? If we go back to these items, go back to the first one, financial assets, we debited 450. As a DT expense. And therefore, I'm going to credit the statement of profit or loss with the balancing figure. And that balancing figure is 126. So that will be deferred tax credit.